at the moment. Germany 30 just marginally lower, France 40 up around 1/3% there. If we move on to what we're seeing in terms of the currency markets at the moment, we've got GBP USD currently trading around 131 currently, really resuming the upward surge we've seen since mid-October. Those are the numbers there. So we're up around 0.1% on the session today. Euro dollar marginally higher, as is dollar yen there as well. Looking ahead to the US session as well, just time to do that. There we've got Wall Street cash, US 500 and the US Tech 100 all looking for a slightly open start to this Friday session. But let's take a look now at those non-farm payrolls. As I say, we've got just under 3 minutes to the headline number comes through, Chris. Everyone was looking for that 185,000 number, but ADP came in so much lower than expected, well, half the number expected. So that really puts a little bit of a down on what we're expecting today, doesn't it? It
does to some extent. Of course, the relationship between the two is always a bit debatable, but nonetheless, it does tend to lead from one to the other. I think it's important to watch out for, and that gives us room for a positive surprise to a greater or less degree where non-farms are concerned, really. It's been a good couple of months for the US. Generally, PMIs have been weaker this week, so that again puts us in a bit of a negative frame of mind. I think it's important to watch out for any surprises on the upside here. Now remember, of course, we're heading towards the Fed meeting next week, of which they're expected to do nothing. If you get a shocker, that might change expectations, but very much a case where the job report still remaining relatively solid means both the President and the Fed have got something to take away from this, and if you get a good number, both can point to their strategy of working as well. So it's a key one to watch out for. Yeah, in terms of the numbers, just a reminder that we had a strike, we had walkout by GM staff that really hit last month's NFP numbers. So 46,000 due to be added to this month, which could play into what we see today as well. As Chris was saying there, the Fed really reiterating that it's not on a preset course. It's very much data dependent at the moment. Yeah, no, it makes sense really. We've had those rate cuts that take the Fed away from where they were, arguably too tight at the beginning of this year, and the Fed has moderated policy as a result. But from the look of it, I think they remain happy with things are as they stand. It will take not just 1 month of bad data. And of course, January is always a bit of a funny month as well, given the holiday period. So we'll need quite a trend, I think, in terms of losses to start to suggest a deviation from that course. We're not looking for any movement on policy until April, which I think is the general expectation now. So let's take a look at some of the movers we're seeing in terms of the markets. If we start by looking at maybe the dollar index, in terms of what we're seeing, of course, what we're seeing in regards to the US and China trade talks has played into what we're seeing in the dollar. But for today, we're trading it. We're just less than a minute away from NFP. Yeah, I think dollar index is another way. We've seen quite a big move over the last year or so. Of course, expectations of even Fed loosening haven't been able to dissuade this from moving higher. Expectations, of course, of economic strength, which is what has been delivered. If you look at the tough time we've had in the Eurozone, of course, the turn lower in Asia as well in terms of economic data. More bad Aussie data this morning as well, interestingly enough. So it's really putting pressure on other markets. But the US continues to sail ahead, and that's the key one, I think, to watch out for, really, is that we get further recovery in the US, which should, again, continue to bolster the greenback because people are looking for exposure to that stronger economy. In terms of the US markets, as we said, at the moment we're looking for a slightly higher open. Currently, Wall Street, around at the moment we're 277.23. Yeah, again, it's been a good recovery here for the US, and I think it really puts, interestingly, whether we have further to go on this side. Of course, we're into December, the usual very strong month. I am going to stop you there. We are getting NFP number coming through. We've got 266,000. So without what you were saying, ADP could impact it to the downside. Actually, we've got it coming in at 266,000. That versus the 180,000 that we were expecting to come in there. Unemployment rate 3.5% versus the expected 3.6%, with average hourly earnings 0.2% versus expected 0.3% there. So a real surprise to the upside. Be interested to see if we get a revision as well to October's numbers. Yes, it will. And usually, of course, the first reaction in markets is always the wrong one. So you've got US markets spiking on this news, the Dow moving back towards 27,800 on that report. Expectations that you might see further gains from there. Of course, the big query is really how much this can affect the US economy, because every time you think they've reached full employment, they pull another number like this out of the hat. So maybe it suggests that perhaps the Fed will almost start to tighten a bit more. Could be one of the expectations we see emerging from this once we've seen a way through the data. The average hourly earnings, nothing too spectacular there, but it's a US, it's a mature economy, it's very strong, and we shouldn't expect spectacular wage growth even at this point in the cycle, really.
Yeah, important there you mentioned that instinctive move we see when we get these kind of numbers is really important to remember when trading anything like non-farm payrolls, is we always see an immediate reaction and then things start to settle and you get to see a real trade.
Yeah, the first move can be the wrong one, and it often the way with clients they try and play this is going long and short on the open in the sense that it will catch both moves, and often it will stop you out both ways. I think that's the important thing to remember. So these volatile moments can lead you into perhaps rash trading decisions, and frequently if you're not sure what's going to do next, the best thing to do is to step aside and wait for the dust to settle. We've not had a big volatile non-farm sprint for quite some time, really. We're not in that crisis phase anymore, but it is perhaps important to remember that we can still see big moves around these numbers, particularly as today when you get this kind of big change in expectations, really big impressive beat on those forecasts.
A reminder of what we're seeing: 266,000 over the expected 180,000. Unemployment rate 3.5% versus expected 3.6%, with average hourly earnings coming at 0.2% as well. So as you say, a massive beat there. That's what we're currently seeing on a euro dollar at the moment. We've got a 5-minute candle, because here at IG you can see down to a second candles to really see the impact numbers like non-farm payrolls do have on what we're seeing at the moment. I think we always say about non-farm payrolls at the moment, it used to be, maybe it still is, the most important US economic data out there, but it was globally as well. But because what we're seeing in terms of, I suppose, what else is happening with politics and other fundamental issues at the moment, where does it stand?
Less so now, really. And of course, many years ago, long before I was around, it was the case that US trade data was the big event of the month. And then suddenly non-farm payrolls has assumed this importance, I suppose rightly so, because of the economic crisis and the subsequent recovery. Now it has diminished. It's not quite the same stature it once was, because we are firmly in not even recovery mode anymore. This is economic expansion. So we know the US continues to create jobs. It would be the shocker if we saw a negative reading. But it is this strength in the dollar and the strength in the US economy that really continues to surprise. I said it a few months ago that every time you think the US is at full employment, they seem to just pull another impressive reading out from the back of the sofa, and that's exactly what they've done today. And you can see the impact in euro dollar really dropping considerably on the 5-minute chart reaction there. And we saw euro dollar right there, that's dropping back from the highs of the week really, and resuming even on this 5-minute chart the downward trend that's been in place since the beginning of the year. So this is, you might see that candle reverse. I would not be surprised if we're on the 5-minute chart, but if you're zooming out, you can see the direction of travel not just over the last few months, but go back in to the sort of almost really the last year in fact, and you can see that how we've been seeing further downside in euro dollar, with an ECB meeting of course next week, widely expected to acknowledge the weakness in the eurozone economy. Then perhaps this will be the catalyst for another leg lower in euro dollar.
Yeah, we were talking about the October number and whether we'd see a revision on that from the 128,000 that we were given in November. It has actually been revised upwards to 156,000 as well.
Another solid number, really, for the US economy. So it's impressive how these revisions keep coming through to the upside, and it will be worth watching this number next month, of course, because it might get revised down just a touch. But it is a very impressive beat, and not one we've seen this strong for quite some time, really.
Yeah, I think one of the interesting things in the US at the moment is looking at the split between manufacturing and indeed the services sector, and how the weakness we've seen in manufacturing, if that was spilling over to the services, that was one of the key things I suppose the Fed looking for. Yeah,
and it was the debate of how much will this feed through. Is manufacturing as important for the US as it used to be? It might be a rather political point as well, of course, given Trump's obsession with bringing jobs back to the US. But I think that the statement is there that the US economy is much more developed than it was decades ago, and of course manufacturing has assumed a lower importance, and so just because you are seeing weakness in manufacturing does not mean that it reads through to the rest of the economy. The services one, like in the UK, is still the crucial one. 2/3 of the US economy is consumer spending. If that continues to hold up as it has done, retail sales at an all-time record high on total sales, if you look at the cumulative figure, that's continuing to rise. And broadly, while the stock market is not the economy, as long as retail sales continue to rise, then you can assume that the stock market will continue to follow that pattern. That's why you've seen so much strength in US markets. It's been a huge outperformance compared to the likes of Europe and of course the FTSE as well. But it seems as if that is set to continue in the near term. Really, we've seen that recovery already this week.
What about the impact we are seeing on the labour market from the US-China trade talks? And we've had a load of comments out this week and we've seen the markets reacting to that. I know one of the impacts on the manufacturing side, they say, is putting down to the US-China trade talks.
It is. If you look at the earnings season just gone, the number of companies mentioning trade wars as a problem has increased, and it's an important thing to bear in mind. I think at this stage, again, I can't believe we're saying this, but we'd hoped that there would be some kind of resolution by this point. Of course, there isn't. Just this week, both sides really talking down the prospect of a deal, at least in the first half of the week. And I think that is feeding through to USA to some extent. You are seeing US companies trying to find ways around these tariff problems. Chinese firms as well trying to move production to other parts of Asia in order to escape being hit by these tariffs. And I think that the trade war stuff, it commands so much attention. It is the noise around which the market moves on a daily basis. But over the weeks and months, we're at record highs. So clearly trade wars aren't having the big impact on the stock market that people thought they would. The assumption was trade wars would lead to a big market crash. It hasn't done. It's led to volatility. But ultimately, the lesson of 2019, as you can see on the chart, has been that volatility has provided the opportunity to go long as and when the sell-offs arrive. You had that one in August. It was also the case about 3 or 4 days in September, and then we've moved higher again. This week has been a classic example as well. Monday, Tuesday, trade war panic. The president seemingly picking on everybody. The Argentinians, the Brazilians, the French, the Chinese, everyone was in the firing line. And then as if by magic, the rally came in December, as you'd expect from a seasonal perspective. And as well, some China trade headlines always help that, but they are the noise. But you have to look at the fundamentals, which are falling jobless claims, rising retail sales, rising US earnings, and indeed a turn higher in the PMI figures this week tends to point to why this market should continue to go up.
A quick check on gold, because of course we've seen that, not surprisingly, moving when we've seen the dollar. Man, we're 14.68 at the moment, a big drop off in the last sort of 10 minutes as well. Yeah,
and of course this resurgence of risk appetite over the last couple of days has done nothing for gold, and we were actually debating this. I think I was discussing with Jerry a couple of weeks back whether we should be long or short gold. He's proven right. You should be short gold. You've seen how these rallies have been the excuse for selling. Yes, we had a modest bounce away from 14.50 over the last couple of days, but it's now turning down once again. This comes in the context of a much bigger move higher since last August, when we were down at 11.60, and it seemed as if gold would go lower, and dutifully it then continued to rally impressively. But a lot of those gains have been eroded as risk appetite returns to stocks, as the equity markets have continued to gain. And you've seen it this week that we had the spike to 14.80, a lower high created an excuse for more selling, and this NFP with that strengthening US dollar is just giving the further catalyst to the downside here.
Yeah, so let's remind ourselves of those numbers that we did get in just, 8 minutes ago. So we saw US non-farm payrolls for November coming in way higher than expected, a lot stronger, 266,000 jobs added. We had average hourly wage growth, 0.2% month on month, 3.1% year on year, with US unemployment coming in at 3.5%. Also a revision to those October numbers coming in stronger, 156,000 as well. So really interesting session there, and that's what we've been seeing today on the market. We got pound against the dollar, 131.23 currently trading. We've got Wall Street currently at 278.18 ahead of that US market open. That's all from us for now. Those are the prices ahead of that open. As you can see, US 500 up a half of 1%, US Tech 100, a real switch from what we saw just 10 minutes ago, and that shows that impact we're seeing from non-farm payrolls at the moment. Want to quickly remind you, though, of course, we've got a big week next week in terms of the UK election. We will be having an extra live show on Friday morning. We will be live at 6 a.m. trading that election result as it comes through, indeed what it means for Brexit, the FTSE 100 and a host of sectors within the UK economy. We'll have the normal 7:30 early morning call and 10:30 charter markets as the reaction to the result really starts to spread across the market. So do join us then. And of course, have a very safe trading weekend.